Welcome back to Wesley Wealth, the channel dedicated to helping you build a lasting fortune step by step. I am your host, Wesley, and today we are stripping away the illusions about getting rich. A major reason why many individuals fail to achieve financial independence is that they are constantly hunting for a quick shortcut. In reality, the most financially successful people in the world choose one of four specific strategic paths, commit to it for a decade, and completely outpace everyone else chasing overnight trends. Remember, no government policy or shifting economy is going to magically generate wealth for you. You must design and execute that reality yourself. When you analyze the absolute wealthiest billionaires on the Forbes list, their strategies fall into distinct categories. Titans like Elon Musk, Mark Zuckerberg, Jeff Bezos, and Larry Page all built their monumental wealth by raising outside capital. Conversely, empire builders like Michael Dell, Steve Ballmer, and the Walton family took the bootstrapping route, while Warren Buffett mastered the art of investing. These examples represent the four fundamental quadrants of wealth creation: combining your money with your business, combining other people's money with your business, using your money for other people's businesses, and utilizing other people's money for other people's businesses. By the end of this video, you will understand the mechanics of each, so you can choose the right vehicle for your journey. The first pathway is bootstrapping, which means relying entirely on your own money to fund your own business. In this model, you start with no outside investors, using your own savings and generated cash flow to operate. You might begin with just your skills, a phone, and a website, trading your time for initial capital, and then systematically reinvesting those profits back into the company to fuel expansion. Common examples of bootstrapped ventures include service agencies, e-commerce stores, local brick-and-mortar shops, and professional business-to-business services. If you are launching your very first business, bootstrapping is highly recommended. As a beginner, you inevitably have a learning curve, and the absolute last thing you want to do is gamble and lose the investment money of your friends and family simply because you are still figuring things out. The greatest advantage of bootstrapping is that you retain total control and 100% of your company's equity. You dictate the timeline, the strategy, and the eventual exit. However, there are significant hurdles. Bootstrapping is almost always the slowest of the four wealth-building paths. Because you are entirely dependent on the revenue you generate to fund your growth, building the business feels like trying to construct a car factory inside a moving vehicle. You will also incur hidden operational debts. Because you lack massive upfront capital, you cannot easily attract a team of top-tier executives who demand massive salaries. This means you take on management and leadership debt. You might also suffer from technical debt by using inferior software because you cannot afford the premium enterprise tools. Ultimately, your lack of capital restricts the types of industries you can disrupt. You could never bootstrap a capital-intensive global robotics manufacturing firm from day one. This leads us to the second pathway, raising capital. This involves using other people's money to build your business. You are the founder and operator, but you sell slices of your company's equity to investors to finance rapid expansion. This is the standard playbook for tech platforms, social networks, and pharmaceutical companies. You choose this path when your vision is so massive that the business must intentionally operate at a loss for years to build infrastructure and capture market share before it can ever turn a profit. Giants like Amazon and Facebook famously burned through cash for years to build their networks before seeing actual profitability. By utilizing investor capital, you gain massive advantages. You can hire the absolute best talent in the industry, vastly outspend your competitors, and scale your infrastructure at lightning speed. It also allows you to pursue rare, high-barrier opportunities that completely price out smaller competitors. However, the trade-offs are incredibly steep. You now serve two distinct masters, your end customers and your investors, whose interests are often completely opposed. You also dilute your personal ownership of the business. Many founders learn the hard way about liquidation preferences and ratchets, meaning that when the company eventually sells, the investors get paid out first, often leaving the founders with a fraction of the expected payout. Furthermore, taking investor money means giving up board seats. Over time, you run the very real risk of losing control and getting voted out of the company you started, which is exactly what happened to Steve Jobs. Finally, venture capitalists expect grand slam returns. They anticipate many failures in their portfolio, but as a founder, you only have one life. Dedicating a decade to a high-stress, venture-backed startup that ultimately fails leaves you with nothing to show for your intense labor. The third pathway is investing, where you take your money and place it into other people's businesses. Instead of dealing with the daily grind of operating a company, you take the income you have earned actively and buy equity in public stocks, real estate, or private cash-flowing businesses. You do not run the operations, you simply provide the funding. This is the famous Warren Buffett model, and its primary appeal is the lifestyle. As a pure investor, you answer to no boss, and your day-to-day operational stress is essentially zero. It also allows for broad diversification, letting you spread your risk across multiple bets rather than tying your entire financial life to a single company. Yet, as Dale Carnegie famously advised, sometimes it is better to put all your eggs in one basket and guard that basket closely. When you heavily diversify, you protect yourself from catastrophic loss, but you also severely cap your upside potential. Investing is also an agonizingly slow process. While real estate investing is the most common way to become a millionaire, it rarely creates billionaires quickly. Warren Buffett is a household name today, but very few people knew who he was before he turned 60. The vast majority of his immense wealth was generated through compounding interest between the ages of 80 and 95. To succeed wildly on this path, you must already have a high active income to generate the initial investment capital, and you must have the patience to let your money compound over decades. Finally, we reach the most powerful engine for extreme wealth, fund management. This quadrant involves using other people's money to buy other people's businesses. You raise a massive pool of capital from limited partners, and you use that pooled money to acquire control of existing companies. The financial leverage available in fund management is unparalleled. Consider the math of a typical private equity fund. If you want to build a $100 million fund, you might personally invest just 5%, or $5 million. You raise the remaining $95 million from your investors. Then, you utilize $200 million in debt to purchase a total of $300 million worth of businesses. If you manage those businesses well, and they grow at an annualized rate of 20% over 6 years, your portfolio's value could swell to $900 million. When you liquidate, you must first pay back the $200 million in debt, plus the accumulated interest. You then return the initial $95 million to your investors, along with a guaranteed minimum return. After all those obligations are settled, the massive remaining profit is split between you and your investors. Depending on the specific terms, your initial $5 million investment can easily transform into $46 million, or even $90 million. This is the ultimate formula for mega wealth, but it is extraordinarily difficult to execute. To attract that level of capital, you must possess an elite track record and a proprietary method for finding deals that no one else has access to. For instance, you might find a highly specialized fund focused entirely on the 30-year life cycle of agricultural timber that cash flows annually and provides a massive payout upon harvest. You need unique insights and networks like that. The primary downside to fund management is the staggering burden of responsibility. You are accountable to regulators, the entrepreneurs running the acquired businesses, the end consumers, and your massive investors. The feedback loop is incredibly long, and your primary job becomes managing risk, reputation, and complex portfolios. You may become incredibly wealthy on paper, but the monumental stress can make you feel like a slave to the fund. These are the 4 definitive pathways to mega wealth: bootstrapping, raising capital, investing, and fund management. You do not need to invent a new way to get rich. You simply need to evaluate your current capital, your risk tolerance, and your unique skill set to select the right vehicle. Which of these 4 paths are you currently walking, and which is your ultimate destination? Let me know in the comments below. If this breakdown brought you value, hit the like button, subscribe to Wesley Wealth, and I will see you in the next video. Keep building. Wesley Wealth, end card / outro.